Hello everyone and welcome back to our channel. In today's video, we're going to simplify ASC 450, Contingencies, which deals with accounting for uncertain events. Contingencies can be tricky to understand, but we'll break it down into simple terms and provide examples to make it easier for you to grasp. So, let's dive in. Contingencies, as per ASC 450, refer to uncertain events or conditions that may have a future impact on a company's financial statements. These events or conditions are not entirely within the company's control, and their outcome is uncertain. It could be a potential gain or loss, depending on how the event unfolds. Now let's look at a practical example to illustrate this concept. Imagine that a company is facing a lawsuit from a dissatisfied customer claiming damages due to a faulty product. This lawsuit creates uncertainty because the outcome is not certain. According to ASC 450, the company needs to evaluate the likelihood of an unfavorable outcome and measure the potential loss associated with it. If the company determines that it is probable to lose the lawsuit and can reasonably estimate the amount of loss, it should record the loss in its financial statements. However, if the outcome is uncertain or the potential loss cannot be reasonably estimated, the company must disclose the contingency in the footnotes to the financial statements. ASC 450 provides guidance on how to measure contingent losses when it is probable that a company will incur a loss and the amount can be reasonably estimated. Let's break down this guidance using another example. Suppose a company manufactures and sells electronic devices with a 1-year warranty. Based on historical data, they estimate that 5% of their sold units will require repairs or replacements covered under warranty. The company must account for these expected warranty costs as a contingent loss. They should estimate the costs associated with the warranty repairs and record them as an expense in the same period they recognize revenue from the sale of the devices. ASC 450 also emphasizes the importance of disclosing contingencies that do not meet the criteria for recognition as losses, but are still relevant to the financial statements. Let's consider one more example to clarify this concept. Suppose a manufacturing company is responsible for cleaning up environmental contamination caused by its operations. The company is uncertain about the extent of the contamination and the associated cleanup costs. In this case, the company should disclose this information in the footnotes to the financial statements. By doing so, they provide users of the financial statements with essential information about potential risks or obligations that may affect the company's future financial position. Understanding ASC 450. Contingencies is vital for accurately representing uncertain events in a company's financial statements. By evaluating the likelihood and measuring potential losses, companies can appropriately recognize and disclose contingencies. Remember, ASC 450 aims to provide transparency and useful information to users of financial statements. We hope that by simplifying this topic and using practical examples, you now have a clearer understanding of how to account for contingencies. If you have any questions, please leave them in the comments below. Don't forget to like this video and subscribe to our channel for more simplified accounting topics. Thank you for watching.